Hello everyone. I will continue with the rest of chapter 9 in this lecture. So in the previous section, we looked at market efficiency, which says that it is not possible to earn abnormal high returns because the stock market incorporates any new information. Then we looked at a different perspective, that is behavioral finance, which says that individuals make mistakes in their investment decisions, which may create patterns or anomalies in the stock markets. Other investors can identify those anomalies and they can try to earn abnormal high returns due to that. Now we look at another perspective or another approach which contradicts efficient market hypothesis. This is called technical analysis. Technical analysis is the practice of looking at historical trends in stock prices, stock returns, or even trading volumes. And it says that these trends will continue in future and we can accordingly take decisions about buying or selling a particular stock. So this approach is in contradiction with the weak form of market efficiency, which says that we cannot use past data to predict future price movements and hence earn profits or hence earn abnormal profits. So what is technical analysis about? The first part is measuring the market. So in this case, an analyst who is involved in technical analysis will look at trading volume, price movements, and based on the trends, they will predict whether it is a time to buy or whether it is a suitable time to sell the stock. So what are the ways to measure the market? There are different measures and we will look at some of them. The first one is confidence index. So in this case, we find the ratio of average yield on high grade bonds versus average yield on intermediate bonds. So if the index rises or if the ratio rises, it is a positive sign for future stock returns. It could possibly mean that the yield on intermediate grade bonds has reduced. If yield has reduced, which means the stock market may rise and it is a positive and it indicates a positive outlook. Then we look at market volume. So market volume means the amount of trade happening in stocks. So if the market is rising and the trading volumes have also increased, so it means it is a positive sign and the upward price movement in stocks will continue. Whereas if the stock prices are moving up, but the trading volumes is decreasing, it means that the bull market or the increasing trend will come to an end soon. So these are some of the future predictions that we can get by looking at the current or the past trends in prices or volumes. Then we look at the breadth of the market. Breadth means the number of stock prices that have gone up versus number of stocks for which the prices have gone down. So the stock whose price has gone up is an advance. The stock whose price has gone down is a decline. So if the number of advances are more than the number of declines, it means the market is strong. So we can expect prices to remain high or to increase further. But if the declines are more than the advances, it means that the market is weak. So we can expect prices to decline. So these are some statistics about the breadth of market. So on a particular day, let's say New York Stock Exchange, how many stocks advanced, how many stocks declined, And that gives us an idea about what would be the future direction of the market, whether the stock market will increase or whether it will decrease. The next measure is short interest. Short interest means the number of uh, shares of stocks which have been uh, under short selling. So we can interpret the short interest in two ways. It means that there is future demand for stock. So, and so a trader will short sell any stock when they expect there will be trading in that stock in future, because they need to cover their short positions in future. The other interpretation is that the market is having a negative outlook. So the trader has taken a short selling position because they expect the stock prices to decline. The next measure is odd lot trading. Odd lot trading means trading in batches of less than 100 shares. This is mostly done by small traders or individual investors. And they have a special trend. These traders tend to enter a bull market towards the late stage, and they also tend to leave a bear market towards the late stage. So if the volume of odd lot trading increases, means there are more small traders who are active. It means either the bull market is coming to an end because they are late entrants, and it could also mean that the bear market is about to end because uh, odd lot traders tend to stay longer in the bear market. So now we look at some of the trading rules or some of the trading conventions that we can follow based on the uh, findings of technical analysis. So what happens is an analyst would look at the supply and demand of different stocks and use mathematical equations to find what would be the future direction of the market. So one is the advance decline line. In this case, we look at the difference between number of stocks which close higher versus number of stocks which close lower. And we plot this difference, advance minus decline, over a period of time. So that leads to a trend, and it may help us to understand whether it is a suitable time to buy or whether it's suitable time to sell. If the graph shows that advances are more, then it is a good time to buy. If the graph shows that the declining stocks are more over a period of time, then it means it's a time to sell stocks. We also look at the new highs and new lows. So we look at the stocks which have reached 52-week high and 52-week lows. So if we consider 52, the stocks which have uh, reached say 52 weeks on a day-to-day basis, then we will have wide fluctuations. Instead, we use a 10-day moving average. That is, we consider a 10-day period. We look at the number of 52-week highs across the 10 days, and we find the average number of 52-week highs. Now we take this 10-day average and we plot it over a period of time. So that is a 10-day moving average. So it helps to reduce the day-to-day fluctuation. Similarly, we can do a plot for 10-day moving average of 52-week lows. So when the 52-week highs are more than the lows, which means the market is strong, so it's a buying opportunity. If the 52-week lows are more than 52-week highs, then it means that the market is weak and it is a time to sell. So this is an interpretation of the plot of the 52-week highs. And another measure is the trading index. So this combines the advanced decline line with trading volume. So we take the ratio of number of advanced stocks by the number of decline stocks, and then we divide it by the ratio of volume of advanced stocks by the volume of decline stocks. So if it's a strong market, we will expect more number of advances, and also the volume of the volume of trading in advanced stocks to increase. So a high trading index number means that it is a weak market. The next measure is the mutual fund cash ratio. This looks at the cash position of the mutual fund. So if the cash position is high, means the mutual fund has additional cash which they would want to invest in the market. When they invest, they will buy, and that will increase the prices of different stocks. If the cash ratio is low, it means that the mutual funds have less cash at hand. So they are not going to invest in the stock market soon. The other interpretation is that if there is any withdrawal done by their investors, the mutual fund would have to sell off their existing holdings, which will decrease the stock prices further. So high cash ratio means it is an opportunity for stock prices to rise. Low cash ratio for mutual funds means there is a possibility that stock prices in the market may go down. The next indicator is on balance volume. So in this case, what we do is we use trading volume in addition to the advances and decline in stocks. So we start from a particular date. We consider the price as well as the trading volume. And on a daily basis, we see whether the stock has advanced or declined. If the stock has advanced, then we add the trading volume to the running total. If the stock has declined, we subtract the trading volume from the running total. So in a bull market, we will see that on balance volume, that is the volume we get from the running total, those values will be higher. And if it is a bear market, that is a weak market, then we expect on balance volumes to be low. So this is another indicator of whether the market is suitable for buying opportunity or for selling opportunity. Relative strength index measures the strength of advances and declines over time. So the index has a value between 0 to 100, and in most cases, the values fall between 30 and 70. If it goes below 30, then it is an opportunity to sell. And if it goes above 70, then it's an opportunity to buy, and we can expect prices to increase further. Then we consider charting. Charting is an important part of technical analysis where we use graphical depiction and try to find trends and decide on the investments, whether to buy or sell. So the price patterns are plotted and they help us to understand support and resistance levels. Support means it is time to sell the stock because the stock price may go below the support level. Similarly, resistance means it is a good time to buy the stock because the stock may go beyond the resistance level. So these are some of the charts that are created using the price movement over time, and from there we get the resistance and support levels and can take a trading decision. So moving average is another type of charting. So in this case, what we do is we take the moving average for the price of the stock. So let's say we take a 10-day moving average. So we calculate the average price over a 10-day period. And then we plot this 10-day average over time. So that gives us a moving average over a period of time. So the moving average is also a good signal of buy and sell opportunities. If the daily price trend, if the daily price plot is above the moving average line, it means that this is a buying opportunity. Similarly, if the plot of daily prices is below the moving average line, then it means it's a selling opportunity. For example, here the red line is a moving average, 100-day moving average. We take the daily prices over a period of 100 days, calculate the average, and then we plot this average over a period of time. So whenever the daily price shows an upward trend with respect to the moving average, it's a buying opportunity. So charting is also a way to look at the historical trends in price and volume, and it helps us to take suitable investment decisions. So that's all for chapter 9. I will end here. Thank you.